welcome to Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lucas de Porbe. I'm Fidelity's global cross-asset specialist. And today I'm pleased to be joined by Anthony Schramm, our portfolio manager for our Asia fund. Welcome, Anthony.
Thanks, Lucas. Good to be here.
So I always like to get a bit of a feel for how people get into the industry, and you've been managing this portfolio for over 10 years. But how did you come about to, from analyst to portfolio manager, how did you get into the industry?
Oh, maybe it's a longer story than that. Got interested in investing when I was about 12.
Wow.
Worked at Macca's for about 10 months, saved $900, and that was the start of it.
Brilliant.
Pretty illegal to be buying stocks now at that age, but back in the day, used to get the Friday Financial Review, Business Review Weekly. Not sure if that still exists, but that was it. So, through your teen years, you're just playing by yourself. My family never had a history of investing. Mm-hmm. And then, you go to uni and you come across the finance course and it's like, dividend discount model and all that kind of stuff. It's like, oh my God, this is exactly what I want to do.
Yeah.
So you go through uni, and fortunately I was able to land a job on the sell side as an assistant analyst after graduating. And that was the beginning of the career, basically.
Yeah, wow. Out of interest, what was the first stock as a 12-year-old that you were looking at?
Foster's.
And
Santos.
And
Ford Foster's.
Was it a buy then? Or?
I don't know. I wasn't that in tune with research. It was like a small shop on the Gold Coast that flogged stocks. So,
Brilliant. I also hear, just as a side note, that you are a very handy tennis player. What level did you get to in tennis? And I guess related to that, what are some of those learnings from sport that you've taken into your investment career?
Yeah, so basically picked up the racket when I was probably about 4 or 5. Dad played at the local club. Eventually got to the national level in Australia. So, national junior championships and all that kind of stuff, which was very good. It was a very competitive age group. We had Mark Philippoussis in that, you may recall. Okay. And there's another guy who ended up becoming the number 1 junior in the world.
Wow.
So it was a tough age group to compete in. What are some of the takeaways and learnings? It's, everyone looks at the physicality of the game, etc., but there's also a huge psychological component. How do you deal with pressure? People's natural instinct is to maybe curl up and be defensive. That doesn't work. You got to push through that. And playing junior sports, I think you have to learn to deal with adversity and conditions like that. And other parallels that I see between sport and investing is, if you want to be a good tennis player, you can't just have a good forehand. You've got to have a good forehand, good backhand, good volleys, good head, good fitness. So the point I'm trying to make is, what I find interesting in the industry is, I'm a value guy. Yeah. I'm a growth guy. Well, this is my strength. And for me, I think you really need to be multifaceted. So as an investor, I'd covered sectors in the past, but I wouldn't say a macro sector. So mining, for example. And analysts, I think, generally hate macro sectors because I don't want to make a macro call. And I just said to the head of research at the time, back in 2008, I want to do a macro sector. I've never done it. I know I'm weak on it, and I want to challenge myself. So again, it's kind of, you've got to push yourself to incrementally get better and better and better and better. Because in investing, the bar is going up, and if you're just staying constant, you're actually getting worse versus the market. So, you can see a lot of parallels between sport and I think the way investing works. Investing, I'd characterize it's a relatively solo sport. Obviously, you've got help, quarterly fund reviews, risk team, analysts, etc. But it's like tennis. I mean, it's you and the other person across the net. No one's holding your hand. Change of ends, you're sitting there by yourself. You're thinking it through. You've got a plan A and a plan B, and investing is very similar. So that's some of the comments I'd leave you with. That I've seen my experience in sport, which was brief, but the level was relatively high. And how that's translated through to investing and parallels I see.
Fantastic. And if you sort of, think about that sporting analogy, I mean, there's some similarities in a way between professional sports and investing. There's a lot of discipline involved. There's a lot of work behind the scenes that people don't see that's involved. And certainly from your perspective, you run a very concentrated, very active portfolio investing in Asian equities, which can be volatile. And you've been doing so for well over 10 years. I mean, how's the market changed over those 10 years? What are some of the key things you've observed that have changed? What's the same?
Markets are always changing. What are some of the key things maybe you've learned, what you've observed? Again, with the context of coming from a developed market background. So, the Australian investment market before going to Singapore in 2006, a bit of a contrast there. Developed markets, it's cheap or it's expensive. You get to Asia and pretty quickly it's ridiculously cheap and not expensive, but ridiculously expensive.
Right.
So kind of the parameters expand. China, for example, a hell of a lot more retail participation. We saw that in 2014, 2015. And again, kind of what you saw in Australia, there's the usual rotation between sectors, say banks or mining or whatever. But you get up to Asia and it's rotations within countries, it's rotations between countries. So there's a lot more to grapple with there. And along the way, you kind of, hopefully you've learned lessons and you continue to learn lessons going forward. So, yeah.
Out of interest, in a market which is so fast moving, and to your point, there are these extremities. How do you keep, I guess, that discipline? Because I could imagine there's a lot of noise and there's a lot of hot money sometimes, and sometimes that hot money comes out of the market, goes into the market. What are the key things you focus in on to maintain your discipline around when you got a lot of this noise around in the markets?
I think it's part psychological. When I grew up, my mum said, "Why can't you be more like other people?" And I never have been like other people. What I'm trying to draw at is when people are swimming one way, I'm going the other way. That's what I found throughout my whole life. So in some degree, it comes a bit natural to do the opposite of what the market's doing. And that can be really, really tough. So, you're going through periods where the market's going up before it crashes, like the A-share China bull market we discussed. The funds were the largest country underweight ever, 20+%. It's hurting every day in terms of performance. And you're like, where does this end? You don't believe it. And as a PM, I'm not going to buy something for the portfolio I don't personally believe in myself. So, there's a few things. Just step away from it. Don't get sucked into looking at your Bloomberg. Stay true to who you are. And again, you've got to eliminate that emotion from investing. I think year to date, it's probably one of the most extreme markets I've seen up in Asia. And to be frank, kind of when you see patches of underperformance, you're always questioning yourself. That discipline you discussed, your process, are you being true to your process? Is it maybe a bit of bad luck that you've run into? And it's always a fine point how much there's skill and luck in investing. But again, it's just going back to your basics. Are you true to form? Are you true to yourself? And how do you capitalize on that up in Asia in terms of my process and the discipline? Sentiment is something that I consider in terms of investing. So which pockets of the market are depressed? Why are they depressed? Do we have a different view? What is our different view? How big is it versus the market? What are the risks around that? And so you kind of go for a repeatable pattern on investing that's sticking to your discipline, sticking to your process.
And that sort of discussion around extremes, it's quite pertinent today in the Asian market. One of the points, and you've been here for a few days, which I found interesting that you made, was the concentration in the Asian market at the moment in terms of the drivers of return. So a lot of our audience may be familiar with the Magnificent Seven, those US tech stocks, your NVIDIAs, your Googles, etc. But some interesting observations from the Asian market as to how it's even more concentrated in terms of return drivers. Can you sort of talk to that? What have those drivers been, say, over the last sort of 6 to 12 months?
Yeah, that's kind of exactly right. I mean, year to date, you're looking at the fund performance, you're looking at the market performance, and you're always questioning what's going on, why. And so, yeah, you're right. Before coming down this week, I was sitting at my desk and looking at what has been driving markets year to date for Asia Pac ex Japan. And to your point, the Mag 7 or Mag 5 or Mag 4, whatever it is, that day of the week, people believe the US market is concentrated in terms of its returns, which it is. Asia is doubly concentrated in my opinion. So if you look at year to date, 2/3 of the market return has been driven by only two stocks. TSMC, about 45%, Tencent in China, the other 20%. So the concentration in Asia is of a magnitude higher than what you get in the US. That Mag 7 that you referred to, or Mag 5, whatever. Year to date, NVIDIA's done about 30-35% of the index gain, and the next four positions odd have done the other 30%. So that gives you a contrast as to what's happened up in Asia. So it's basically been TSMC, Tencent, and nothing.
Yeah, wow.
So if you're not there, it's going to be a challenging year to date, which is the time frame that you're referencing. And we'll see how it goes from here.
Yeah. And if we take that theme of extremities, I mean, one of the things that a lot of investors look at, and obviously you look at, is valuations. So are markets cheap? Are they expensive? Depending on which metric you look at. And if you look at the market at the moment, it's really bifurcated between sort of, I guess, really cheap parts of the market and then really expensive parts of the market. Can you talk about that a little bit more?
Yeah, so there's a few points that come to mind. I think if you looked across decades, and I'm talking going back 80, 90, 100 years, because you do have market data for that. So across country, across the world, I think what comes through pretty clearly empirically is that you buy at expensive valuation multiples at a market level, you're going to get poor long-term returns. Mm-hmm. So valuation being your number one predictor of future long-term returns is a pretty strong empirical argument that you should not ignore. Drilling it down to the region, some of those points that you touched on, where have been the swings and roundabouts? So Taiwan, very expensive. On the flip side, you have China, obviously very depressed, underweight by institutions, and to a lesser degree, ASEAN. I'd say that's a bit more just neglect, lack of liquidity, but I think there's some ideas there. So, if we just hone in on China, from my process, it's flagging up a lot of ideas, primarily on valuation looking cheap, but how do you kind of sort out the value traps from the non-value traps? That's the real challenge. At a high level, what I'd say is if you see stocks that have derated, but the fundamentals haven't, so their margins, their revenue growth, their returns, etc., haven't derated, if you have the view that it's not going to derate, that's probably a starting point, rather than a stock that has derated, but so have returns, margins, and sales, for example. That would be maybe more of your value trap.
Yeah. And conversely, if we look at the Indian market, valuations arguably do look pretty stretched. What's driven that? What have been some of the drivers in terms of that market rallying hard?
There's been a couple of drivers. I think if you go back, to give you context, 18 months, 3 years, China institutions didn't want to deal with. So Asia's hard. China's even harder. I don't want to deal with it. Go back to the comment I made earlier about rotation within the region. It was an easy thing to sell China, buy India. So in the first instance, I think it was much more driven by, let's call it, foreign capital. My sense is that's started to exit from back end of last year to the point where foreigners are, I'd say, on the underweight side for India. But the second leg of what's driven the market higher has been a huge amount of uplift in retail participation in India, both equities and also the derivatives market. So, you're seeing volumes going through 150% higher in the market than what they were 18 months ago. That to me is kind of, I wouldn't say a frenzy or mania, but have you seen parallels in the past? Yeah, sure. If you go back to 2014, 2015, the China A-share bull market rally, it gathers up steam and then turnover's ballistic. And I think India's exhibiting some of those similar characteristics, maybe not to the same degree, but gives you a sense of what's driven the market higher.
One of the statistics I have heard you mention is if we sort of focus back onto China and valuations is price to book. So price to book is a valuation measure. And I think you were sort of talking about historically, in different market pullbacks, for example, the global financial crisis, what stocks were trading at that point. What are some of those similarities, analogies? Because I think it's an interesting one in terms of that whole sort of, at what point do things become so cheap that you can't ignore and you've got to look at them?
Yeah, it's, again, that comment I made about empirical evidence and market valuations and being a predictor of future performance. Again, if you look multi-decades across the world, in my personal experience, what I found is about 0.3 times book is as bad as it's going to get unless you're going out the back door. So then it's it's a question of, are there catalysts or does the company just need to keep doing what it's doing? Does the market eventually recognize the thesis, i.e. that rotation that we discussed? My personal opinion is it's quite likely it will in the absence of, something material like going out the back door. Why is that? My philosophy is markets are, cyclical. They'll mean revert. When is that going to happen? I'm not sure. But say, for example, you're buying something at 0.3 times book, you've got a hell of a lot of buffer to work with in the belief that that's not going to be written down materially. So again, kind of lift over some stones, talk to the analyst, do your work. So what I'm saying is pretty not much goes wrong at 0.3 times book or below.
Yeah. And it's sort of as long as the fundamentals of the company
Correct.
remain there. One of the interesting changes in your portfolio in recent times has been around that AI theme. So you had some reasonable exposure more broadly to tech, and you've taken some of those profits and wound that back. And AI is just, it comes up in every conference, everyone's talking about it. What are some of the observations and what are some of the broad reasons that you did pull back from that position, which is a bit of a contrarian position, I guess, given the buoyancy in some of those big AI names. Interested in your thoughts around that.
Yeah, so if we wind back the clock 12 months ago, 9 months ago, information technology was the largest sector overweight for the portfolio. So this is not e-commerce or platform stuff. This is hardware, tech hardware. So TSMC, MediaTek in Taiwan, Jinding in Taiwan, SK Hynix, which does memory in Korea, ASML, which basically provides equipment to foundries and memory producers. And AI was never part of the investment thesis. So the fund was overweight IT before ChatGPT hit the headlines in March 23. More on a fundamental view that the memory cycle is likely to turn. AI turbocharged the returns from a lot of those companies. What was the catalyst to start dialing back exposure? There's a few things that went through my mind. One is I don't believe the market narrative on AI. Two, valuations re-rated exceptionally quickly to the point where your bull case for these companies was met. Again, bearing in mind, has the thesis changed? I don't think it has. So that's another thing that's going to tip you over the edge to sell. And again, just look at, maybe psychological behavior in the market. And have you seen patterns of this in the past? And one thing I can point to you is look at how analysts justify recommendations on companies like this. Instead of using, say, 12-month forward rolling EPS multiplied by a PE multiple gives me a target price, which is what they always use. Or to your point, maybe memory would be price to book and see what it has been through cycle. What you're seeing is, well, I can't justify ASML or TSMC on rolling 12-month forward EPS anymore. I've got to go out to 2027, 2028. And I'm going to whack the same multiple on there, and Bob's your uncle, you've got a 50% higher price target. But as an investor, let's discount that by the return you want per annum, and you're kind of not too dissimilar to where the current price was. Maybe 5% different, 8% different. But given the risks I see in terms of the thesis playing out on AI versus, say, that 5 to 8% buffer, I don't think it's worth it. So again, parallels where we've seen this happen in the past. The most recent example would be what happened to the China pharma sector leading into COVID. Wuxi Biologics, Wuxi Aptech, Jiangsu Hengrui, these kind of companies became very expensive. Analysts want to keep it on a buy, and they stretch out 4 or 5 years to justify it. End of the story.
Yeah.
That's just one example, but you've seen this happen in the past. So, from my perspective, you see a lot of great work on what's high bandwidth memory and what's happening with large language models, etc. But show me where's the research on the risks around AI? Where can it go wrong? I had a meeting a long time ago. It's actually at a mining conference, meeting a kind of, let's call it a mining entrepreneur, still in the business. And I remember in that meeting, he was saying, the market will do what fools consensus the most.
Right.
And okay, look, consensus can be right sometimes and right for a little while, but when you put that in context and you look back, let's call it 3 decades or 4 decades, you had the Asian tigers, 96, 97, falls out in 98.
Yeah.
Tech boom, 98, 99, nothing can go wrong. Boom, 2000. US housing, 06, 07, boom, all over in 08. A-share bull market rally, 14, 15, finishes. Lithium.
Yeah.
So how is what we're seeing with AI different from that?
Yeah.
Everyone thinks they understand it. I think no one really understands it.
Yeah.
And the risks aren't captured in what we're seeing in the market today. So that is why, the fund is now underweight tech hardware for a lot of those reasons I just discussed.
Yeah, yeah. The whole sort of psychology of it's fascinating, that sort of over exuberance. And on the flip side, you can get over pessimism as well in some parts.
Which I think we're yet to see.
Yeah, yeah.
AI.
No, really interesting. Maybe just to wrap it up, I guess we're in a challenging market, in a market of extremes. We've talked about valuation. I mean, where are you seeing opportunities? What's sort of exciting you the most at this point in time? Korea,
China, ASEAN. So definitely not where the market really is. So, working on one idea in Korea, bearing in mind what you mentioned at the beginning of the podcast, concentrated portfolio. You don't need to look at 20 ideas. 2, 3 or 4 can do really well for you over a 12-month period. So one in Korea, there's about 3 or 4 in China, but again, just very cognizant of trying to sort the wheat from the chaff and not get wrapped up too much in value traps. Thailand, Malaysia at the moment. 1 in Thailand, 1 in Malaysia. You've got some ideas in Indonesia, but let's just say they're more skewed to the private sector banks where valuation has not retraced sufficiently, but you keep them on your radar screen. So, yeah, there's a few pockets of the market that you think, there's opportunity there, but you still got to deal with the issues of Taiwan, India, etc.
Yeah, absolutely. Absolutely. Well, Anthony, we might leave it there. That was a great discussion and much appreciated, and thank you for your insights.
No, thanks, Lucas.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform, or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.